Why gold isn't behaving? There is a war escalating in the Middle East. Missiles are flying. Oil facilities are being threatened. Major powers are positioning military assets in one of the most volatile regions on the planet. The kind of headlines that for decades have sent one particular asset surging while everything else flinched. Gold, except gold isn't surging. Not the way it should. Not the way the textbook says it should. Not the way every financial instinct built up over a century of market history says it should. And that silence, that stillness in a metal that is supposed to scream when the world gets dangerous is telling you something important. Something about the dollar, about American debt, about the strange geometry of a financial system under quiet but serious stress. The question isn't why the Middle East is on fire. The question is why gold isn't. To understand the answer, you need to understand what gold actually is, not the romantic version, not the jewelry, not the doomsday prepper's basement stash. Gold in financial markets is a bet against confidence. Specifically, a bet against confidence in the dollar, in central banks, in the idea that the people managing the global financial system know what they're doing and will continue to do it. When that confidence is high, gold sits quietly. When that confidence cracks, gold moves. Geopolitical conflict historically cracks confidence. Wars disrupt supply chains. They create inflation, they destabilize currencies, they make the future feel genuinely uncertain. All of that should push investors toward gold. And yet here we are. The reason gold isn't responding the way it used to has almost nothing to do with the war itself. It has everything to do with what is sitting on the other side of the trade. And let's talk about the US-Israel relationship, because it is directly relevant to why gold is misbehaving and not in the way most people think. The United States and Israel have one of the most entangled strategic relationships in modern geopolitical history. American military aid to Israel runs into the billions annually. American diplomatic cover at the United Nations has been consistent for decades. When the Middle East escalates, the assumption built into market pricing is that the United States will be involved financially, diplomatically, and potentially militarily. That assumption has a cost. Every time conflict in the region deepens, the market begins pricing in the possibility of increased American defense spending, broader regional involvement, and the fiscal consequences of both. That means more Treasury issuance, more US government borrowing, more supply of the very bonds that underpin the global financial system. And this is where the story gets interesting, because more Treasury supply means higher yields. And higher yields means something very specific for gold. Here is the mechanism that explains almost everything. Gold does not pay interest. It does not yield anything. It sits there. Its value is purely in what it represents, which is a store of value outside the paper money system. US Treasury bonds, on the other hand, do pay interest. And right now, that interest is significant. The 10-year Treasury yield has been hovering around levels not seen consistently since before the 2008 financial crisis. At points in 2023 and 2024, it pushed above 5%. When you can put your money in a US government bond and earn 5% annually with essentially zero default risk, the opportunity cost of holding gold becomes very real. Gold gives you nothing while you hold it. The Treasury gives you 5%. So when geopolitical stress rises and investors look for safety, they face a choice that didn't exist in the same form 10 or 15 years ago when yields were near zero. They can buy gold, the traditional safe haven that pays nothing, or they can buy treasuries, the modern safe haven that pays 5% and is backed by the largest economy and military in the world. A lot of money is choosing treasuries, and that choice is suppressing gold in the exact moment gold should be shining. This explains some of the reasons why gold price has not been behaving in a way expected by many.